I've been watching silver markets for over a decade, trading my own capital and maintaining access to institutional data feeds most retail investors never see. And what I'm looking at right now at 2:30 this morning is something I haven't witnessed since the Hunt Brothers era. While you were sleeping, silver was sitting at $89.90. Just hours earlier, it had kissed $93.75, a new all-time high, before getting violently rejected back down. The overnight session was eerily quiet. No panic selling, no celebration. Just this strange, tense silence that tells you the big players are recalculating their positions. Now, if you flip on CNBC this morning or scroll through the financial headlines, here's what they're going to tell you. They're calling this a speculative bubble, a temporary spike driven by geopolitical jitters and retail hype. They want you to believe that the 31% year-to-date gain in just 14 days is some kind of anomaly that will mean revert by Monday morning. They're already dusting off their return to fundamentals talking points. But here's what they're not telling you. The price you're seeing on your brokerage app isn't reflecting a bubble. It's reflecting a structural fracture in the physical silver market that's been building for half a decade. The system isn't just reacting to news anymore, it is breaking under the weight of its own mechanics. And behind the scenes, a very specific trap has just been sprung. The paper shorts, the institutions that have been betting against silver rising, are currently suffocating. And most people watching this unfold have no idea what's actually happening beneath the surface. And let me be clear about what I'm claiming here. This isn't just about a round number. This isn't about silver hitting $90 and everyone getting excited. This is about a systemic fracture that has been caused by 5 consecutive years of structural deficit in the physical silver market. And that fracture is now physically crushing the global solar industry in real time. And what we're witnessing is a transition. Silver is moving from being viewed as a trade, something you speculate on for a few percentage points, to being recognized as a strategic necessity, the kind of asset governments start worrying about, the kind of commodity that gets added to critical minerals lists and export restriction discussions. Here's what I'm going to walk you through in this video. I'm going to explain the actual mechanism behind what's called deep backwardation and why it proves this rally is fundamentally different from anything we've seen in the modern era. I'm going to run the math on the global inventory collapse and show you why the numbers simply don't add up to a resolution. And I'm going to share my personal battle plan for navigating the volatility that I believe is coming in the next few weeks. Because if you think that $93 peak was the end of this move, you fundamentally don't understand the inventory trap that's currently being set. Let's get into it. I was looking at the data a few hours ago, and here's what the screen was showing me. Spot silver was at $89.90. That's the price for immediate physical delivery. Now, compare that to the January 2026 COMEX front month futures contract, which was trading at $91.87. Stop and think about that for a second. The future delivery price is nearly $2 higher than the buy it now price. In a normal, healthy commodity market, that doesn't happen. Normally, futures trade at a small premium to spot because of carrying costs, storage, insurance, financing. But a $2 gap on an $89 asset, that's not a carrying cost. That's a distress signal. This is what the professionals call backwardation, and when it gets this steep, it tells you one thing with absolute clarity. There is desperate, immediate demand for physical metal that cannot wait for future delivery. Now let me give you the context that makes this truly alarming. We are currently in the 5th consecutive year of a global supply deficit in silver. The estimates for 2025 range from 160 million to 200 million ounces short. That means industrial users, investors, and mints need 200 million more ounces than the mines and recyclers are producing this year. 5 years in a row. Think about what that does to inventories over time. You can't run a deficit forever. Eventually, the cupboards go empty. And we're seeing the consequences play out in real time. Trina Solar and Jinko Solar, these aren't small companies, these are 2 of the largest solar panel manufacturers on the planet, have both issued official warnings about net losses in their upcoming earnings. Why? Because silver costs have tripled in the last several months, and silver paste represents a material input cost in every single photovoltaic panel they produce. These companies are the backbone of the global energy transition. Governments are subsidizing solar installations to the tune of hundreds of billions of dollars. And the industrial supply chain is starting to crack because one critical input, silver, is becoming too expensive and too scarce to source reliably. Then you have the vault data. Goldman Sachs published a note recently stating that price sensitivity in the London Bullion Market Association vaults is up 3.5 times compared to last year. Translation: the physical inventories sitting in London, the traditional center of the global silver market, are unusually thin. It doesn't take much buying pressure to move the needle when the available float is this small. Here's the reality. The paper price you see quoted on your screen is a suggestion. It's a number generated by contracts and leverage and margin requirements. The physical reality is a ransom note. If you need actual metal delivered to your facility next week, you're going to pay whatever it takes. And that's what the backwardation is screaming at us. Let me explain what deep backwardation actually means, because this is the technical concept that unlocks why this situation is so dangerous for the shorts. In a normal commodity market, the future price trades at a small premium to the spot price. That's called contango. It reflects the cost of storing and financing the commodity until the delivery date. If you're holding a short position in contango, it's actually profitable over time. You collect that premium as the contract rolls forward. It's a comfortable trade. But when the market flips into backwardation, everything reverses. Now the spot price is higher than the future price. That means if you're short, if you've sold a contract promising to deliver silver at a certain price, you're bleeding money every single day, you don't deliver the physical metal. Let me give you an analogy. Imagine you're driving home and your gas tank is empty. You pull into a gas station and they offer you two options. Option 1, pay $10 per gallon right now and fill your tank immediately. Option 2, pay $5 per gallon, but you don't get the gas until next month. They'll send you a voucher. Which one are you choosing? You're paying the $10. Because you can't drive a voucher to work tomorrow morning. You need the physical gas now, and you'll pay the premium for immediacy. That's what's happening in silver right now. The industrial users can't wait. The solar companies can't wait. The mints can't wait. They need physical metal delivered to their facilities, and they're willing to pay a massive premium over the paper price to get it. Now here's why this kills the shorts. In a normal contango market, holding a short position is relatively easy. The market structure is working in your favor, but in deep backwardation, the market is effectively charging you a desperation fee every single day you don't deliver the actual metal. The longer you wait, the more expensive your position becomes. And what we're seeing right now is the steepest backwardation in silver since 1980, since the Hunt brothers tried to corner the market. That's not speculation. That's the historical data. This proves that the rally we're experiencing isn't just retail hype. It's not Reddit forums pumping a meme. This is a physical market that is literally starving for supply. But here's the twist. While the physical market is suffocating, the dealers, the large institutions who make markets in these contracts, are preparing a counterattack. And if you don't understand how they operate, their next move could wipe out unprepared retail traders in a matter of hours. Let me run the math for you, because this is where hope dies and reality sets in. The United States Geological Survey recently added silver to its critical minerals list. That's a big deal. It puts silver in the same category as lithium, cobalt, and rare earth elements. It signals that the government now views silver as strategically important to national security and industrial capacity. Now, when a commodity gets added to that list, everyone starts talking about demand reduction and recycling. We'll just use less, we'll recycle more, problem solved. Let's test that theory. Even if the global solar industry manages to increase silver recycling by 10%, which would be a massive operational achievement, it doesn't come close to filling a 200 million ounce annual deficit. The math just doesn't work. And let's talk about thrifting. At $90 per ounce, solar manufacturers are desperately trying to reduce the amount of silver paste they use per panel. The engineering teams are working overtime, but the current estimates suggest they can maybe reduce silver content by 5 to 10% without destroying panel efficiency. That saves you maybe 10 to 20 million ounces globally. You're still short 180 million ounces. There's no amount of efficiency gains that closes a gap that large in the near term. Now, here's where it gets interesting. There's an unverified rumor circulating in the institutional space about a large physical delivery request in London. The number being whispered is 1,000 metric tons. If that's true, and I want to stress this is unconfirmed, that represents a massive chunk of the available LBMA vault float. We're talking about a delivery that would drain a significant percentage of what's actually sitting in storage and available for immediate allocation. Now let's contrast the paper market against the physical reality. Look at the CME open interest in silver futures. These are the contracts representing claims on future silver delivery. Then look at the actual registered vault stocks, the physical metal that is available to be delivered against those contracts. The ratio is staggering. Current estimates suggest there are more than 30 claims on paper for every 1 physical ounce that is actually sitting in a registered vault ready to be delivered. 30 to 1. Stop. Go pull up the chart of the LBMA vault inventories over the last 4 years. I want you to see this for yourself. The slope of that decline isn't a gentle curve, it's a cliff. Month after month, the inventories have been draining. The pace of the drain has been accelerating. The music has stopped. But there are still 30 people circling one chair, and everyone's pretending the game can continue indefinitely. Now let's address the skeptics, because there's a credible counter-argument that I need to dismantle before we go further. The skeptics are saying this. The Trump administration has announced tariff exemptions for critical minerals. That removes the fear premium that was driving silver higher. The 93.75 peak was a blow-off top driven by panic, and now we're going to revert back to $68, maybe even lower. This is the view coming out of HSBC and TD Securities. It's not a fringe opinion. These are serious institutions. Here's my response. Tariff exemptions do not create more silver in the ground. Political announcements create noise. They create short-term volatility. The dip from 93.75 back down to 89.90 this morning, that's noise. That's traders reacting to headlines. But noise doesn't fix a 200 million ounce structural deficit. You can't policy announce your way into more physical supply. The mines take years to expand. The refiners are already running at capacity. Recycling can't scale fast enough. So yes, political news can create a temporary sell-off. It can shake out the weak hands who are trading on momentum. But it doesn't change the underlying physical reality. Now let me destroy another myth while we're here. Silver is just a play on gold. It's a leveraged bet on monetary policy. That was true for decades, but it's not true anymore. Silver has fundamentally changed categories. It is now a strategic industrial asset. The USGS listing proves it. The government now views silver the way it views lithium or cobalt, as something essential to the industrial base and the energy transition. This isn't jewelry. This isn't just a store of value. This is a commodity that you cannot build solar panels without. You cannot manufacture electric vehicle components without it. You cannot produce the infrastructure of the modern economy without it. So let's checkpoint and recap what we know so far. The price hit $93. The solar industry is issuing profit warnings because input costs have tripled. The physical vaults are at stress levels we haven't seen since 1980. The backwardation is screaming desperation. And the structural deficit is in its 5th consecutive year with no resolution in sight. If the skeptics are wrong, and I believe they are, the next move isn't a correction. The next move is a gap up. Because once the market realizes the physical shortage is real and unfixable in the near term, the price discovery process is going to get very violent, very quickly. So what happens next? Let me walk you through the institutional playbook, because this is how the dealers are going to try to regain control. First, watch for margin hikes at the CME. This is the classic counter move when the exchange or the large market makers start feeling pain. They increase the margin requirements on futures contracts, which forces leveraged traders to either post more collateral or close their positions. There's an unverified rumor that the CME is considering a margin hike as large as 100%. I can't confirm that. But historically, when markets get this volatile and the shorts are this exposed, margin hikes are the weapon of choice. Why? Because it forces liquidation. Retail traders who are long silver futures suddenly get margin calls. They don't have the cash to meet the new requirements, so they're forced to sell. That selling pressure drives the price down temporarily, which gives the shorts room to cover some of their positions at better prices. It's a brutal but effective tactic, and it's legal. Second, expect the media narrative to shift. You're going to start seeing stories about silver recycling breakthroughs. New technology allows solar companies to reclaim 90% of silver from old panels. Industry executives confident that supply concerns are overblown. These stories serve a purpose. They calm the industrial panic. They give the shorts a narrative to point to when they're defending their positions to their risk committees. And they create doubt in the minds of retail investors who might be thinking about buying more. But here's what I'm watching. I'm watching 2 very specific signals that will tell me whether the physical shortage is real or whether the dealers can successfully suppress this rally. Signal number 1, silver lease rates. This is the cost of borrowing physical silver for short-term delivery. If lease rates cross 35% on an annualized basis, the game is over. That level of borrowing cost means there is absolutely no available supply to lease, and the shorts are completely trapped. Signal number 2, Chinese export policy. China is one of the largest refined silver producers in the world. If Beijing announces export restrictions on silver concentrate or refined silver, citing domestic industrial needs or strategic reserve building, the global supply chain will fracture overnight. Watch for that announcement. It could come without warning. The system is about to change the rules because they're losing under the current ones. That's what powerful players do when the mechanics turn against them. They don't accept the loss. They rewrite the mechanics. Now, let me share my personal battle plan. And I need to be very clear here. This is not financial advice. This is not a recommendation. This is my personal journal of how I'm thinking about my own portfolio and my own capital. You need to make your own decisions based on your own risk tolerance and financial situation. Here are my triggers. Trigger 1, I'm watching the $84 level. That was the prior breakout level before this recent surge. If silver retests 84 and the price bounces strongly, meaning we see significant buying volume come in at that level, I am viewing that as the ultimate buy the dip confirmation for my own physical allocation. I've been adding to my physical stack for years, but if we get a flush down to 84 on a margin call driven sell-off, I'm personally looking to increase my allocation significantly. That would represent, in my view, a gift. Trigger 2, I'm watching silver lease rates very closely. If they stay above 30%, and especially if they climb toward that 35% threshold, I am ignoring any paper price drops. Because if lease rates are that high, it tells me the physical market is completely disconnected from the paper market, and any sell-offs are just artificial raids designed to shake out weak hands. In that scenario, I'm holding my physical. I'm not trading it. I'm not getting cute. I'm just holding. Now, let me give you my conditional actions, the if-then statements that will guide my next moves. If silver dips to the $82 to $84 zone on a margin call flush, I'm personally looking to increase my physical allocation. I'll be calling my dealers. I'll be checking premiums. And if I can source metal at reasonable premiums over spot, I'm buying. If we see a daily close above $95, I will move my trailing stops on my mining stock positions up to $89. I've made significant gains on my mining positions since the start of the year, and I want to protect those gains while still leaving room for the position to run higher if this rally continues. If the CME announces a margin hike of more than 50% in a single day, I'm sitting on my hands and waiting for the dust to settle before making another move. Those kinds of shocks create chaotic price action, and I don't trade chaos. I wait for clarity. Now, take a look at the volume profile on that 89.90 bounce this morning. Look at how much volume came in to defend that level. That's not retail. That's institutional money. That's big players saying, we're not letting it go lower than this. When you see that kind of volume defense at a key technical level, it tells you something important. The big money believes the lows are in, at least for now. They're not trying to catch a falling knife. They're deliberately stepping in. Let me bring this all together. We've broken $90. The physical vaults are the emptiest they've been in decades. The backwardation is at levels we haven't seen since 1980. The industrial users are panicking. The deficit is structural and unfixable in the near term, and the ratio of paper claims to physical metal is 30 to 1. The paper shorts are trapped in a room with no exits, and the floor is on fire. You can follow the headlines if you want. You can listen to the bank analysts telling you this is a bubble that's going to pop. You can wait for the safe entry point that might never come. Or you can follow the physical metal. You can look at the vault data, the lease rates, the backwardation, the deficit numbers, and the industrial panic, and draw your own conclusions. I've made my decision. I know what I'm watching. I know what my triggers are. And I know that the opportunity to position for a structural shift like this does not come around very often. If you want to understand how we got to this breaking point, if you want to see the full history of the LBMA vault drain and understand why the inventories collapsed in the first place, you need to watch my previous deep dive on that topic. That video explains the why behind the what we're seeing today. I'll link it for you. This is a historic moment in the silver market. The system is reacting. The rules are about to change, and the next few weeks are going to separate the people who understand what's happening from the people who are just reading headlines. Stay sharp, watch the data, and I'll see you in the next one.